Please note, this video is based on chapters 5 to 7 of Larry Williams' book, How I Made $1 Million Last Year Trading Commodities. I will leave down below an Amazon link for the book in question. Furthermore, in this video, I will assume that you have already watched my videos about condition analysis and price action. If you haven't watched these videos, then please find below links to the videos in question. Let's say you have completed your condition analysis and you have identified a promising trade idea for a particular commodity. You take a look at the 52-week price chart of the commodity. Fortunately, the market is currently range bound and its most recent trend supports your analysis. Does this mean you are ready to trade? Well, not quite, but you're close. Allow me to explain. Before you can trade, you need to perform two checks that pertain to gap analysis and market leadership. Gap analysis. A gap occurs when there is no market activity between two preceding candlesticks. So, for instance, this is an example of a market gap because there has been no market activity in between candlestick A and candlestick B. But this is not a market gap because even though the opening price of candlestick A is a lot higher than the high of candlestick A, there has been some market activity in between the candlesticks in question. Overnight gaps are rare because of market liquidity and 24-hour access to the markets. However, gaps still occur after weekends and public holidays. When a market is range-bound, you need to measure the magnitude and direction of each gap. Make sure to express this as a percentage of either the high of the first candlestick for up gaps or the low of the first candlestick for down gaps. Afterwards, add up all your gap percentage measurements. If the total is a positive number, then the direction of the market breakout will probably be on the upside. And if the total is a negative number, then the direction of the market breakout will probably be on the downside. Naturally, you want to make sure that your condition analysis supports your gap analysis. Market leadership. Let's say you want to hold a long commodity position. Naturally, you will want to buy the most bullish commodity that is in the most bullish commodity group. And obviously, if you are going to hold a short commodity position, then you will want to sell the most bearish commodity that is in the most bearish commodity group. There are 5 commodity groups. The groups are as follows. Number 1, energy. Number 2, precious metals, including cryptocurrencies such as Bitcoin. Number 3, industrial metals. Number 4, agricultural. And number 5, livestock. You can easily measure the performance of a commodity by calculating its percentage change during the previous 52 weeks. You can then measure the performance of a commodity group by calculating either, number 1, the average performance of all commodities that belong to the group, or number 2, the performance of an appropriate commodity index. You will need to, number 1, compare the performance of a commodity against the performance of its commodity group. And number 2, compare the performance of a commodity group against the performance of other commodity groups. Here's an example. Let's say you want to trade gold on the long side. You make a note of the following performance numbers for the previous 52 weeks. So we have gold at 20%, silver at 12%, platinum at 14%, the Dow Jones Energy Index at 25%, the Dow Jones Industrial Metals Index at 4%, and the S&P Agricultural Index, which includes livestock, at minus 1%. Based on the performance numbers for gold, silver, and platinum, we can estimate that the overall performance of the precious metals group is equal to 20% plus 12% plus 14%, all divided by 3, which equals 15.33%. Gold has a performance of 20%, so clearly gold is the market leader of precious metals. However, the energy index has a performance of 25%. Therefore, under this set of circumstances, instigating a long position in gold might not be a good idea. Consequently, you have 2 options. You can either, number 1, wait for the precious metals group to become more bullish, or number 2, try to find and develop a long idea involving an energy commodity. A market entry strategy for commodities. Okay, let's say you have completed all your analysis involving number 1, premium spreads, number 2, COT data, number 3, open interest, number 4, market leadership, number 5, price action, and number 6, gaps. You now have a commodity trade idea that has gone through your entire filtering process. Does this mean you are now ready to trade? Yes, it does. For our market entry, we will use a short-term percentage R indicator, which we'll define as follows. Let C equal the most recent closing price of our commodity. Let H equal the market high during the previous 10 days. Let L equal the market low during the previous 10 days. And so we have the percentage R equals H minus C, all divided by H minus L. Please note, the term days refers to business days. When a market makes a new 52-week high, then ideally we should buy immediately. And when a market makes a new 52-week low, then ideally we should sell immediately. Unfortunately, the problem with such an ethos is that it is too obvious. This means too many traders will instigate their trades in this manner, and this will lead to a lot of false breakouts and retracements because of a build-up of tight stop loss orders. The key is to instigate your position after a false breakout or retracement. Several legendary traders used this trading concept, including Jesse Livermore, Nicholas Darvas, William O'Neill, and Larry Williams. So here is a market entry strategy that takes into account the existence of false breakouts and retracements. To buy a commodity. Step 1. Whilst in an uptrend, wait for the percentage R indicator to reach 100%, i.e., the market is making a short-term low. Step 2. Wait 5 business days. Step 3. Wait for the percentage R indicator to fall below 95% and then buy, because the market is leaving a short-term low in order to resume its prevailing uptrend. However, the total waiting time since your percentage R reading of 100% should be less than 21 business days. Also, during this waiting time, there should be a decrease in market volatility and volume. To sell a commodity, step 1. Whilst in a downtrend, wait for the percentage R indicator to reach 0%, i.e., the market is making a short-term high. Step 2. Wait 5 business days. Step 3. Wait for the percentage R indicator to go above 10% and then sell, because the market is leaving a short-term high in order to resume its prevailing downtrend. However, the total waiting time since your percentage R reading of 0% should be less than 21 business days. Also, during this waiting time, there should be a decrease in market volatility and volume. If you have any questions, then please either send me an email or leave a comment down below. Thank you for your time and happy trading.